Welcome to Talk Tickers.
Good to be here.
You know, usually when we do these deep dives, we're looking at the flashy stuff.
Yeah.
The AI bubble, the energy transition, the latest earnings disaster.
Right.
But today, we are doing something different. We are crawling under the floorboards.
Into the plumbing.
Exactly. We're looking at the engine room of the U.S. stock market. Because if you placed a trade today, and it is Friday, January 23rd, 2026, you're interacting with a system that is, well, in the middle of a massive, legally complex, and honestly, somewhat chaotic renovation.
Chaotic is definitely the right word. We're talking about the SEC's amendments to Regulation NMS.
The National Market System.
That's the one.
Which sounds incredibly dry. I can already hear listeners reaching for the skip button.
Don't do it.
But don't do it. Because this isn't just bureaucratic red tape. This determines the price of every single share you buy or sell.
That's right. I mean, we are talking about a battle royale between the SEC, the courts, and the biggest exchanges in the world. NASDAQ, CBOE, NYSE.
All over this.
It's all about tick sizes, access fees, and whether a penny is actually, worth a penny anymore. And while it sounds technical, these rules affect roughly 67% of all U.S. market share volume. 2/3
of the volume. So this is the water in the pipes for the majority of the market.
It is. And the situation right now is just bizarre. The rules were finalized back in 2024. The courts technically upheld them in late 2025.
But here we are, January 2026, and the biggest changes are in limbo.
Total limbo.
So let's set the scene. Our mission today is to explain the half-penny rule, the massive cut-in fees that comes with it, and the changes to round lots that are actually live right now. But let's start with the headliner.
Half-penny revolution.
The half-penny. For as long as I've been trading, and probably since decimalization happened decades ago, stocks trade in pennies. You buy at $10.01, you sell at $10.02.
Yep.
But the SEC wants to take a hatchet to that penny. Why break something that seems to work?
Because for a huge chunk of the market, it isn't working. To understand why, you have to understand a concept called being tick constrained.
Okay, let's unpack this. Define tick constrained for us.
Okay, so imagine a stock that is incredibly liquid. Huge volume, everyone wants to trade it. Supply and demand naturally want the spread. The difference between what buyers will pay and sellers will accept to be tiny.
Okay.
Maybe a fraction of a cent.
Because there's so much competition to get the trade done, the buyers and sellers are practically hugging each other in terms of price.
Precisely. But under the old rules, the minimum increment, or tick, was hard-coded at 1 penny.
0 to 1 cents.
Right. So even if the market wanted to trade with a spread of half a cent, it couldn't. It was artificially stuck at a penny.
It's like going to a store where everything costs $9.99, but you only have $10 bills and the clerk isn't allowed to give you change.
That is a perfect analogy.
You're overpaying simply because the currency denomination doesn't fit the product.
You're forced to pay a wider spread than necessary. And in the stock market, that wider spread is essentially a tax on investors. It's just friction. So the SEC ran the numbers and they identified these tick-constrained stocks. They defined them as stocks that have a time-weighted average quoted spread of 0.015 or less.
So basically, stocks that are bumping up against that penny floor constantly, they are desperate to go lower, but the rules just won't let them.
Exactly.
And this isn't a small list, right? I mean, is this just Apple and Microsoft we're talking about?
No, it's about 1,633 stocks. Now, numerically, that is only about 15% of all tickers.
It's small.
It does. If you look at the total number of companies listed, it seems small. But, and here is the key insight, those stocks represent 67% of the total share volume in the U.S. market.
That is wild. So the vast majority of actual trading activity, the stuff moving billions of dollars a day, is happening in stocks that are essentially trapped by this penny rule.
Right. It's the Apples, the Nvidias, the big banks, the stocks everyone owns.
Mm-hmm.
So the new rule says for these specific stocks, the minimum tick size drops to a half penny or 0.005.
Pricing fidelity. That's the term the SEC uses, right?
Yes. The theory is that by allowing a half-penny tick, you let the market find a true equilibrium price. If the buyers and sellers want to meet at 10.005s, now they can.
You aren't forcing them to widen out to a full penny just because the regulations say so.
Right. It reduces transaction costs for everyone.
But here is where I get confused.
Yeah.
How do I know if the stock I'm trading is a half-penny stock? Does it just switch back and forth day to day? Because that sounds like a headache.
Oh, that would be a nightmare for the algorithms and the back office systems.
Yeah.
No, it is a dynamic model, but it's evaluated on a very strict schedule.
Okay, so how does a stock earn its half-penny stripes?
The primary listing exchanges So where the stock lives, like NYSE or NASDAQ, they have to run an evaluation twice a year.
Okay.
They look at data from two specific periods, January to March, and then July to September.
So it's a look-back period. They're checking the report card.
Right. If a stock fits the criteria during that review period, meaning it had that zero point 0 and high on 10 spread or less, it switches to the half-penny tick for the next 6 months.
I see.
Specifically, starting in May or November.
So it's not a permanent label. A stock could be a half-penny stock for 6 months. Then trading volume dries up. The spread widens naturally.
And it goes back to being a penny stock in the next cycle.
It goes back.
Exactly. It creates a system that breathes. It adapts to the actual liquidity profile of the stock rather than slapping a one-size-fits-all rule on everything forever.
Okay, so that handles the price. We're slicing the penny in half. But if you change the price increments, you have to change the cost of doing business. You can't separate tick sizes from access fees.
No, you can't.
This is where the exchanges really started screaming, isn't it?
Oh, they hated this. This is a direct hit to their revenue. But to understand why they're angry and why the SEC did it, we have to look at the maker-taker model.
Which always sounds like a playground game, but it's how the U.S. market runs. Explain the mechanics for us.
Well, essentially, exchanges are businesses. They sell liquidity. They need people to post orders that sit on the book so that other people can come trade against them. So if you are a maker, you post a limit order that sits there waiting. The exchange often pays you a rebate.
They're paying me for providing inventory.
Correct. But if you are a taker, you come in and buy those shares immediately because you want the stock right now. You pay a fee to the exchange. That fee is the access fee.
And these fees are usually measured in mils, 1 mil being 1/100th of a penny.
Correct. Under the old rules, the rules we have lived with for years, the cap on access fees was 30 mils.
Which is 0.003 per share.
Exactly. 0.3 of a cent.
Which sounds negligible to a retail trader buying 10 shares.
It does, until you look at the new spread. This is just a math problem. If the spread is now only going to be a half penny, 0.005 cents, and the fee to access that quote is 0.003 cents, well, you do the math.
The fee is eating up, what, 60% of the spread?
Exactly. The economics completely break. If the fee is more than half the potential profit of capturing the spread, nobody is going to provide liquidity.
Right.
The market would freeze up because the cost of trading is higher than the price improvement you're getting.
So to make the half-penny tick work, the SEC had to slash the fee. They couldn't just change the tick size in isolation.
They had no choice. The new rule drops the access fee cap from 30 mils down to 10 mils.
2.001.
For stocks priced over $1.
That is a massive cut. That is 2/3 of that revenue stream gone overnight for the exchanges.
And that is why the exchanges NASDAQ, CBOE, NYSE went to war. They rely on that revenue to pay rebates to the high-frequency traders and market makers who provide liquidity.
Of course.
If you cut the fees, you cut the rebates. The exchanges argued this would break the incentive structure of the market.
But the SEC held firm. And before we get to the legal drama, there's one more layer to the fees that I think is actually a huge win for transparency.
Oh, the determinable fees rule, yes.
This sounds boring, but I feel like it solves a major headache.
It really solves the mystery box pricing problem. Previously, exchanges had these incredibly complex fee schedules. I mean, pages and pages of tiers. You might get charged one rate if you traded X amount of volume at the end of the month, and a different rate if you traded Y amount.
So if I'm a broker, I place a trade for a client on January 5th. I don't actually know what that trade cost me until January 31st.
Exactly. It was retrospective. You wouldn't know the precise cost or rebate of your trade at the moment you press the button.
Which seems insane for a market that relies on microseconds and precision. It's like buying groceries, and the cashier says, well, I'll tell you the price of the milk at the end of the month based on how much milk you drank total.
That's it. And the new rule stops that. It says fees and rebates must be determinable at the time of execution.
No more waiting.
No more retrospective adjustments based on monthly tiers for that specific trade. You have to know the price on the tag before you buy.
I imagine the agency brokers, the guys representing you and me, love this.
They do. It reduces conflicts of interest.
Yeah.
If I'm a broker, I shouldn't be routing your order to a specific exchange just because I might hit a volume tier at the end of the month and get a bigger rebate for myself.
No.
This forces a cleaner, more predictable cost structure.
So on paper, this looks great. We get tighter spreads via half pennies, lower fees capped at 10 mils, and more transparency. But It is January 2026, and I am looking at my screen and I'm not seeing half pennies. Why are we waiting?
Well, you can thank the D.C. Circuit Court of Appeals, or rather, the fallout from the court case.
Right, the exchanges sued. They argued the SEC was overstepping.
Specifically, NASDAQ and CBOE argued that the SEC exceeded its authority under the Exchange Act of 1934. They claimed the 10 mil fee cap was arbitrary.
Why 10? Why not 12? Why not 8?
Exactly. They essentially argued the SEC pulled the number out of thin air to fit the halfpenny narrative.
And honestly, given the Supreme Court's vibe lately, I'm thinking of the Loper-Bright ruling, that limited agency power. I would have thought the exchanges had a slam dunk case.
Everyone did. That's the twist. Loper-Bright ended the practice of courts automatically deferring to agencies like the SEC. Everyone thought that might sink these rules.
But it didn't.
But in October 2025, specifically October 14th, the D.C. Circuit dropped a bombshell decision. They denied the petition. They sided entirely with the SEC.
Really? Even post-Loper-Bright?
Yes. The court said, essentially, no, the SEC did its homework. They said the SEC has broad discretion to ensure fair and efficient markets, and that the analysis behind the 10 mil cap was reasoned and grounded in data.
It was a massive validation of the SEC's ability to regulate market structure.
Huge.
So the SEC won. Victory lap, champagne corks. Why the delay?
Because winning the war doesn't mean you're ready to govern the peace. On October 31st, 2025, Halloween, the SEC issued an exemptive order pausing the implementation.
They paused their own rule after fighting for it in court.
It was a combination of logistical nightmares. There was that government shutdown lapse in appropriations that threw a wrench in the timeline. But mostly, the SEC acknowledged the industry needed time.
Right.
You can't just flip a switch on the entire stock market's pricing engine overnight without risking a glitch that wipes out billions.
Fair enough. So what is the new date? When does the half-penny revolution actually begin?
The first business day of November 2026. That is when the halfpenny ticks and the new access fees are supposed to go live.
Supposed to? I hear skepticism in your voice.
Well, SEC Chair Paul Atkins released a statement saying that in light of recent events, relief was necessary to facilitate orderly market functions. There is a lot of reading between the lines there. Plus, there is chatter about other rules dropping that might change the game entirely before November.
We'll get to that game changer in a minute, something about the order protection rule. But I want to pivot to what is working right now.
Yes.
Because not everything was delayed.
Yeah.
If I look at stocks like Booking Holdings or AutoZone stocks trading in the thousands of dollars, something has changed.
Yes. While the ticks and fees are delayed, the changes to round lots went live back in late 2025. And frankly, for the average retail investor, this is arguably more impactful than the half-penny thing.
Remind us what a round lot is and why it matters.
For decades, the standard unit of trading was 100 shares. That was a round lot. Anything less, 1 share, 50 shares, was an odd lot.
And odd lots were second-class citizens.
Worse, they were invisible. If you put in an order for 50 shares, it wouldn't necessarily show up on the tape, the official record of the National Best Bid and Offer.
The NBBO.
Right. So if you were a retail trader trying to buy 10 shares of a $3,000 stock...
Which is a $30,000 order, that's not pocket change.
Yeah, exactly. But because it wasn't 100 shares, your order didn't impact the public market price. It was hidden liquidity. It meant the price you saw on the screen wasn't necessarily reflecting all the actual demand in the market.
Which is absurd when stock prices have climbed so high. 100 shares of a $4,000 stock is nearly $500,000. So you needed $500,000 just to affect the price.
Right. So the new rule changed the definition of a round lot based on the price of the stock. It's a tiered system now.
Walk us through the tiers.
Okay. If a stock is priced between, say, $250 and $1,000, a round lot is now 40 shares.
Not 100.
Not 100. If it is priced between $1,000 and $10,000, a round lot is 10 shares.
Okay.
And if it is truly massive, over $10,000 a share, a round lot is just 1 share.
So practically speaking, if I place an order for 10 shares of a stock trading at $2,000 today, that is now a protected quote. It goes on the tape.
Yes. It contributes to the NBBO. It creates visibility. It means the market data actually reflects the trading activity of smaller investors in high-priced stocks.
And I saw something about BOYLO coming to the data feeds, which sounds like a cop show acronym. Put out a BOYLO on that suspect.
It does, but in this case, it stands for Best Odd Lot Order. Starting in May 2026, the SAPs, the data feeds that power most retail trading screens, will start disseminating full odd lot information.
Okay.
So even if your order isn't a round lot, if it's the best price available, people finally be able to see it clearly.
That is huge for transparency. So zooming out, we have half pennies coming in November. We have round lots active now. We have lower fees on the horizon. Whenever you change the plumbing this drastically, someone's basement gets flooded. Who wins and who loses here?
The clearest winners are investors who are just trying to buy stock cheaply. Retail investors, pension funds, mutual funds.
Right.
Narrower spreads mean better fill prices. If you're buying Apple and the spread is half a cent instead of a cent, you are saving money every time you trade. Over a lifetime of investing, that compounds.
And the losers, besides the exchanges losing their fee revenue?
Market makers. If you make your money on the spread and the spread just got cut in half, your margins are squeezed.
Right.
They have to trade twice as much volume to make the same profit. But there's another group that's a bit of a wild card. High-frequency traders.
HFTs. I would have thought regulation hurts them.
Not necessarily. A half-penny tick creates more price points. It creates more granularity. That means more opportunities for arbitrage, more opportunities to step in front of orders by a smaller increment.
Right, the pennying issue, or I guess now it's half pennying.
Exactly. This is the central academic debate of market structure. Fidelity versus complexity. Fidelity is the argument for the half-penny. Smaller ticks allow prices to settle closer to their true value. It's cleaner.
Okay.
But complexity is the counter-argument. If you make the ticks too small, like if we went to 1/10 of a penny, you get flickering quotes.
The data changes so fast, no human can react.
And it discourages people from posting limit orders because they just get picked off by faster computers jumping ahead of them by 1/100th of a cent.
Right.
The SEC is betting that the half penny is the Goldilocks zone. Not too big, not too small. It's an empirical bet that for these 1,600 stocks, the penny was just too clunky.
So, final question. We talked about a potential game changer earlier. We are building this complex half penny structure, but is there a chance the foundation gets pulled out from under us?
There is, and it centers on the Order Protection Rule, or OPR.
What is that?
The OPR basically says brokers must route an order to the exchange with the best price. You can't ignore a better price on NASDAQ just to trade on NYSE.
You're obligated to protect the investor's price. Sounds reasonable. Why would anyone want to get rid of that?
Because that obligation is the only reason we need fee caps. If I have to route to your exchange because you have the best price, you can hold me hostage and charge me a huge access fee.
I see. The regulation creates the monopoly power.
It does. But if the SEC decides to scrap the OPR, which some people, including Chair Atkins, have hinted at, then the whole justification for capping fees changes.
Because if I don't have to route to you, I can just ignore your exchange if your fees are too high. Competition handles it naturally.
Exactly. So we're in this weird position where we are installing high-tech plumbing, the half pennies, the fee caps, based on a rule that might get deleted in a year or two.
We're renovating the bathroom in a house that might be scheduled for demolition.
That is the risk with financial regulation. The market moves fast, and the rules are always playing catch-up.
Well, until the wrecking ball comes, or doesn't, we will keep watching the plumbing. November 2026 is the next big date. Until then, enjoy those smaller round lots and keep an eye on your execution prices.
Thanks for having me.
That's it for this deep dive on Talk Tickers. See you next time.